If there's one thing community banking has a lot of, it's terms and acronyms. We're going to break down the most common ones, tell you what they are, more importantly, tell you why you should care. Let's get started. Let's talk about loan participations. What we're going to talk about is what does this term mean, and also why should we care? So first off, what is a loan participation? It's an agreement between two banks to jointly fund a loan. And there's no limit to how many banks participate in a single loan, but the loan participation itself is an agreement between two parties. One that is the originating bank, which is referred to as the lead bank, and the second is a participant bank. And it's probably easiest to just give this one as an example. Let's say that you as a banker have $1 million loan that you want to fund and you're going to be participating it out. What the participation would do is we would effectively split that loan to maybe a $500,000 loan kept by me as a lead bank, and then $500,000 will be funded by the second bank. Now, one thing to be really aware of in the case of a loan participation is this is different than having a first mortgage, second mortgage, third mortgage. In the case of a participated loan, this is a shared position. So this is still one loan. There's still one $1 million loan. It's just the financing of it is shared with $500,000 coming from me as the lead bank and $500,000 coming from the participant bank. Now, what a lot of times this will be referred to as a pro rata interest, which just means we're sharing that interest proportionate to what our share of the total financing is. Now, in the case of a participated loan, the lead bank provides all of the day-to-day servicing for the loans. They send out the statements, they collect the payments, they do the annual reviews, and they are the face to the customer because to the customer, they are their bank. Now, in exchange for that, the lead bank would retain what's called a servicing fee. And that's a negotiable amount, typically about 0.25%, that's negotiated between the lead bank and the participant bank. So let's say, for example, the loan that we're going to participate has an 8% rate, and we've agreed to a 0.25 servicing fee. What would end up happening is the borrower still pays the loan as if it's 8%, but when the lead bank collects the payment and then gives the principal and interest payment to the participating bank, they would only collect it as if it was a 7.75% loan rather than the 8% loan. And that little bit of difference, that 0.25, that's what's kept by the lead bank in exchange for the servicing activity that they're doing. Now, another thing to be aware of with participations is that often the borrower doesn't even know that this has even happened. More often than not, they're still working with just their lead bank or just the lead bank who is their bank. And unbeknownst to them, their financing has actually been shared. Now, that's not a hard and fast rule. There's plenty of times where customers will be aware of the fact that the loan's been participated, but often they don't. Now, why should we even care to begin with? Well, a lot of these revolve around the three main reasons why I, as a community banker, have participated loans in the past. Now, the first one might be because you want to lower your risk. Now, this is probably relevant on a loan that was kind of on that marginal category where you're on the fence on whether or not you want to do the financing. Well, one thing that could go and help you is that maybe you feel better financing $250,000 in this scenario versus a full $1 million. And so by participating out, in the case of a $1 million loan, I've had participate out $750,000 to other people and I retain a quarter. Now maybe it fits the risk profile of the bank and that loan gets done. Now, another reason could be to manage legal lending limit. So banks have limits to how much they can borrow to any one particular borrower. And so one way of helping to make sure we meet that in the case of a customer who's really large or has a really large request is that we can go and share that financing with somebody else. So if we have a $10 million legal lending limit, but a borrower wants to do a $15 million loan, we can still do it. It's just we got to go and find a participant to share with us of that excess $5 million that would be over our legal lending limit. Now, the third one is one that a lot of people don't actually think of, but you can actually use loan participations to increase your effective interest rate for your loan using that servicing fee. Now, the case where this would really apply is when you have a loan that to get it has to be priced lower than what you would like. And what you can end up doing is by participating out a higher share, you as the lead bank get to retain that servicing fee, and the larger share of the overall loan that you participate out, it can actually increase your effective rate by quite a bit. And maybe it'll be enough to go and get it into an acceptable spot for you to still do the deal. And that's what you need to know about loan participations. Hey, if you're a community banker and you enjoyed this video, I got 2 more things for you. The first, consider subscribing to the channel. And the second, head on over to mybankerguide.com for your free copy of the DSCR cheat sheet. The DSCR is the banker's favorite ratio, so learn how to calculate it, learn what to watch out for, and then how to make sure that you get it right every single time so that your loans are more likely to get repaid.